Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing MP Materials stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. MP is a rare earth materials company. It owns and operates the Mountain Pass mine, the only operating rare earth mine and processing facility in the US. Its focus is on producing neodymium and praseodymium. That's a rare earth material used in high-strength permanent magnets that power EVs, robotics, drones, and other advanced motion technologies. In February of this year, President Biden announced the Department of Defense was investing $35 million into MP as part of an effort to spur domestic rare earth production in the US. This company was funded by a SPAC, a special purpose acquisition company is formed to raise money through an IPO, then acquire a private business to help them go public. In November 2020, the merger was completed. The SPAC that acquired MP was Fortress Value Acquisition Corp. The company is headquartered in Las Vegas, Nevada, and was founded in 2017. The ticker trades on the Nasdaq, Mexican Bolsa, and Sao Paulo Stock Exchange. Let's get started with the model. This is a mid-cap company, 6.3 billion market cap. They're trading at $36 a share, and they have 178 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So you can see they had their first positive in the trailing 12 months, positive 54 million. Net income is the profit or loss on the income statement. It's revenue minus expenses. That was negative in 19 and 20, positive in 2021, and even higher in the trailing 12 months. Revenue is the sales for the company, and that goes up 6x from 73 million in 2019 to 438 million in the trailing 12 months. This is the company's income statement. The top line is the revenue of the sales. Below that is the cost of revenue. These are all the expenses directly related to generating the revenue. Revenue minus cost of revenue gives you your gross profit, and that goes up a lot each year from 5.5 million to 61 million to 230 million up to 333 million. Below that is their operating expenses. These are the expenses not directly related to generating the revenue, such as marketing. Gross profit minus operating expenses gives you your operating income. That also goes up a lot each year from negative 7.6 million to 260 million. Below that is the interest they paid on their debt, which is about $10 million. That's about triple 2019's number. Below that is other income and expenses. These are all the gains or losses not part of the company's core operations. When you see a big negative, it's probably an asset impairment. Then you have your pre-tax income, your taxes, and the bottom line of the income statement is your net income, which was negative in 2019 and 2020, up to over 200 million in the trailing 12 months. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. You could think of operating cash flow as net income converted to cash, because net income is your accounting profit or loss. It's not actual cash. They had a small negative in 2019, a small positive in 2020, then it jumped up to 100 million in 2021. Now it's well over 200 million in the trailing 12 months. They spend a decent amount in CapEx. These are investments in property, plant, and equipment, 159 million in the trailing 12 months. Operating cash flow minus CapEx gives you your free cash flow. And they had their first positive free cash flow in the trailing 12 months at 54 million. Since they had negative free cash flow before the trailing 12 months, it looks like they added a lot of debt in 2021, 690 million. And when they IPO'd in 2020, they received 544 million in capital stock. Let's look at the capital structure. 1 billion of equity, 700 million of debt. They're 62% equity, 38% debt. And they could pay off all the debt with the cash on their balance sheet and still have 557 million of cash left over. Their WACC on Finbox ranges from 7% to 8%. I use the middle one of 7.5%, and that's the discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated the terminal value, which is all cash flows past year 4, that's 3.7 billion. We discounted those numbers back to today's and the weighted average cost of capital. We get a value of the company of $3.2 billion. We divide that by 178 million shares. And we get a calculated stock price of $18. They're trading at $36, so they're trading at a 99% premium. It's a sell according to the model. Their revenue forecast in 2024 is $838 million. In 2023, it's $688 million. In 2022, it's $529 million. And I continued this trend into 2025, and I got $990 million. That's how I got their future revenue estimates. The average company in their industry converts 18% of their revenue into free cash flow. So I multiplied their future revenue estimates by 18%. That's how I got their future free cash flows. The website Simply Wall Street is in the other direction. They're at $44 a share. They're saying it's 18.7% undervalued. 8 analysts priced this stock, and the average price target is 52, the lowest 45. The high price target is 60. So everybody's a lot higher than me. When a SPAC starts trading, it's always at $10 a share. Most SPACs, I'd probably say 9 out of 10, are trading below $10 after a year of getting acquired. And a lot of them are trading below $2. So this has done really well. The stock is flat in the past 52 weeks, while the S&P is down 9%. The 52-week low is 29, the high is 60. And the stock is trading below its 50-day and 200-day moving average. 3 million shares are traded each day on this stock. Of the 178 million shares outstanding, 92 million are on float, 69% are held by institutions, and it has a high short percentage. Over 12% of the shares are shorted. If you invested $10,000 into this company when they started trading, you'd be at $36,000 today. That's a 260% return. In the past 12 months, there's been lots of insider trading, mostly sells. 1 million shares, 6 million, 800,000, and 4.4 million. The buys are only 45,000, 34,000, 86,000. 39% of the company is held by institutions, 31% by hedge funds, 13% by the general public, 10% by insiders, and 8% by public companies. When you invest in a company, you like to see their employee count go up. This indicates they have demand. And in the past year, it looks like their employee count is up a little bit. They're currently at 365 people. Their biggest shareholder is JHL Capital. This is a big investment fund. They own 22% of the company. James Litinsky, the founder and CEO, QVT Financial, Vanguard, BlackRock, State Street, Omega Advisors, etc. Let's look at their financial ratios. They have a PE of 31, that's stock price over earnings per share. Price to sales of 14.5, price to book of 5.8, and they have a really high price to free cash flow of 117, that's stock price over free cash flow per share. Generally, the lower the better for these ratios. Their return on invested capital is 39%. They have a high interest coverage ratio of 27, that's EBIT over interest expense. A good ROE of 19%, that's net income over equity, a lot higher than the market median and average, and a really high current ratio and quick ratio. They did generate positive free cash flow in the trailing 12 months, but they have a ton of working capital. So they definitely have enough funds to get through the next 12 months. The best way to look at ratios is to compare them to companies in the same industry. There are 40 companies in the same industry as MP, and if MP has a number in red, they're worse than the average. If they have a number in blue, they're better than the average. They spend less in CapEx than the average company. Their debt to equity ratio is not bad, but it's a little worse than average. For every dollar of equity, they have 60 cents of debt. Of course, they don't pay a dividend yet. They just started generating positive free cash flow, so it's a lot smaller than average. They rank 5th in market cap of all the companies. All their price multiples are worse than average. When a company has a really high PE or price to free cash flow, this indicates the market expects a lot of growth from the company. If a company has a really low price to earnings and price to free cash flow, the market is not expecting much growth. And they generate a small amount of revenue, and they do have a really good ROA and ROE since they now have positive net income. The average is negative in the industry. To summarize, I have them trading at a 99% premium, and it is hard to value this company. There's so much potential, and the stock could go a lot higher well before they generate lots of profit, especially when President Biden gives this company money. I know investors really like that, and it pushes the stock price higher. So if they can keep winning these types of relationships and contracts, the company will do really well. But obviously at some point, they need to generate a profit. I rank their free cash flows 5 out of 10, their revenue 7 out of 10, and their ratio is 4 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.